Thursday, October 1, 2020. Getting to zero tax, part 2. Itemized deductions, Schedule A. This is the 39.6 Facebook and YouTube Live Finance Show. This is a show that teaches high earners like yourself how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, paying for childcare, paying for college, even the car you drive. We continue tax week. It may be more like tax month, but we're continuing tax week right now with another episode of Getting to Zero Tax. We're going to walk you through Schedule A, Itemized Deductions. If you're out there and you can hear me, you can see me, please let me know. All right. So first I'm going to show you, we are going to go back and we are going to look at Physician on Fire's tax return. Okay, just so you all recall, on Physician on Fire's tax return, which we went through a few episodes ago, we went through the first portion, which was income. Then we went through the adjustments, which is line 8A, to get to line 8B, which is your adjusted gross income. That's like the most important part of your tax return is your adjusted gross income. So sorry, I'm going to scroll back down to that. Okay, and then from your adjusted gross income, you then take off either the standard deduction or itemized deduction. So that is line 9. This used to be on the second page of the 1040, but now it's on the bottom of the first page because they've combined a bunch of other rows together and made it simpler or shorter on the 1040 form. Now the standard deduction, again, if you're married, for this year is $24,800. For last year, 2019, is $24,400. And if you are single, it's half of that, $12,200. Okay. So you have a choice between taking the standard deduction or itemizing. Okay. Now, remember we talked yesterday and the day before about tax credits and how those can help you get down to zero tax. Okay. Like the child tax credits, $2,000 per child. That helps a lot. Okay. Then a lot of people can put money into their 401k. That's money if you're an employee that does not even show up on your 1040 form at all. It does not even show up on your W-2. So it's not going to go here to line 1 where it says wages, salaries, and tips on your W-2 form. Okay, so those are easy ways to decrease your taxes. Now, what often people talk about are all the quote-unquote deductions they can take. Okay, now there are business deductions, and then there are personal deductions. Business deductions are going to go on Schedule C, which we'll go on separately and do a separate episode on. Okay. Or they could be from a partnership and then they would be on Schedule E. But Schedule A is where we have itemized deductions for personal expenses, not business expenses. Okay. So we are going to go through Schedule A. I'm going to switch the screen real quick and pull up Schedule A. All right, so here is Schedule A. Show up there? Okay, I think we can do side by side. There we go. Okay, so Schedule A, and I'll try to make it a little bigger. Oh, I think I'm going to have to go to spotlight mode for you. Okay, to make it really bigger. So here is Schedule A, itemized deductions. Now, it's changed a little bit with the Tax Cuts and Jobs Act. The main thing that people talk about that is no longer in Schedule A is the lack of unreimbursed employee expenses. That means costs you have for your job as an employee that are not reimbursed. So for example, let's pretend you're a physician and you're going to a conference, a CME conference, continuing medical education. If your job does not reimburse you for that and you had to pay for it and go to that meeting to get the credits you need to stay credentialed and meet all your accreditation requirements, those are business expenses. But as an employee, you used to have to put them on here in order to have a chance to get a tax deduction if your employer did not reimburse them to you. They actually got rid of that with the Tax Cut and Jobs Act. So that was one of the things they took away. But they did increase the standard deduction up to $24,400. So they made it a lot higher. It was about half as much before, I believe. All right, so that part no longer exists. They still have this portion at top, which are medical and dental expenses. Most people, if you are working, you are not going to be able to deduct that because you have to first calculate your AGI, the adjusted gross income, and take 7.5% of that. That is the minimum you would need to have in medical or dental expenses that are not already reimbursed. So if you have like an FSA or an HSA, and you're using those monies for costs for that tax year for 2019, you cannot count those expenses. They have to be like unreimbursed medical or dental expenses. And the first 7.5% of your adjusted gross income, if those expenses are less than that, you don't get to deduct any of it. If it's more than 7.5% of your adjusted gross income, you only get to deduct the amount that is more than 7.5%. So if you make $200,000 a year, 7.5% of that would be $15,000. You would need to have $15,000 of unreimbursed medical expenses. And then only the dollars above and beyond that would be deductible here. Okay, so you don't need to have a lot. This is more useful for people who are retired. Their AGI may be very low, and they may have a lot more medical or dental expenses. Okay, but most working younger people are not going to be able to take any deduction there. Okay, the two most common deductions that people put on Schedule A. So if you own a house, okay, so once somebody buys their first house, they often start itemizing, okay, because you can often get over the standard deduction. So the first part are taxes that you pay, and the second part is interest you pay. Okay, so taxes you pay on that are not federal. Okay, so your state and local taxes called SALT tax. So that can include state income tax if you live in a state with income tax like California, Jersey, New York, and a lot of others, but not Texas, not Washington State, Nevada, I don't think. So those state taxes can be included in line 5A. If you live in California and you make $1 million, you could easily be paying, let's say, 8% of your money to state tax. So that could be $80,000. Okay, if you make $500,000, it could be like 5%, 6%, and that could easily be $25,000 to $30,000. Okay, now you would put that amount right here. Okay, as your state income tax. Then you can add your state and local real estate tax, okay, and state and local personal property tax. So real estate tax would be like your taxes on your house, the house you live in, your homestead. So in states that have state tax, is usually a lower percentage. In states that have no state tax, it's usually like 1% to 2%, maybe. Maybe up to 3%. In states with the state income tax, often the property tax might be like half of what it would be. Okay, so for example, where we are in Texas, in our city, it's a 2% property tax rate on the appraised value, which is actually a pretty reasonable assessment of your valuation of the property here. Other states often do like half of the value is the appraised value, but here it's actually pretty close. It's 2%, but then it's your own house as a homestead, then there's like a 20% exemption off of that. So instead of being 2%, then it becomes 1.6%. Okay, so if you have like $1 million house, that's $16,000, $500,000 house, $8,000, $200,000 house, $3,000. Okay. Now, you add up your state income tax, your property tax. If you live in a state that does not have state income tax, you can use sales tax instead. And one year we went through all of our credit card statements and tried to calculate all of our sales tax we paid. because that was our first year in Texas, because we didn't have to pay any state income tax, and there was no limit on SALT tax. So we did that. It was very painful. You had to like take out all of the international charges, because when we traveled, or charges that we did in other states, and come up with how much sales tax we paid. There's actually a much easier way to do this. You can just type in your zip code into like a table, and I think your income, and they estimate your sales tax paid for you, which is a reasonable estimate. And you can just do that, and it's super easy. Now, if you paid for something like very expensive, then you might want to try to count up your your sales tax that you paid instead. But all of this really does not matter anymore, because in line E, it says enter the smaller of all of the others combined, or $10,000. That's assuming you're married. If you're married filing separately, it's only $5,000. That $10,000 is very, 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 very easy to get to. Okay, you could live in a state with 6% income tax, or let's just say you're paying a 4% tax, and you make $100,000. You're already at $4,000 of state income tax. Then you have a house, and you have a house that is, let's say, $250,000, and you're paying 1%. So that's $2,500. That's $6,500 just on those two things. Okay, and that's on a lower amount of or a median amount of income. Okay, but if you're making more money, or you're in a higher tax state, or you have higher property tax, $10,000 happens very fast. Okay, our property tax bill is in excess of $10,000, but that's because we don't pay state income tax. If we paid state income tax, we actually, we could easily be paying we'd be paying tens of thousands of dollars in state income tax. Living in a state without state income tax is a gigantic bonus. It puts thousands of dollars into our pocket every single month. If we were paying state income tax, that could easily be more than our mortgage. It could be more than childcare, even combined. Like if we lived in California, what we would be paying state income tax would be more than what we pay here for our housing and childcare. Those two things combined are like by far our biggest expenses outside of tax. Okay. Now, so this is all capped out at $10,000. So state and local taxes are $10,000 total, including property tax and state income tax. And then there's also personal property that can be taxed, but that doesn't apply to most people. Okay. So the next one is interest you pay. So that's your mortgage interest and points. So if you bought a house in 2020, this year, and you file your taxes next year, if you paid points to buy down the rate, those points would be included as an expense for your mortgage, and you would be paying interest and the points. So let's pretend you buy a $300,000 house, and you have a 3% interest rate on it. So you're paying $9,000 a year in mortgage interest. So then that $9,000 is mortgage interest, and that would get tacked on top of your state and local tax. Let's pretend your state and local tax is capped at $10,000. So then you'd have $9,000 of mortgage interest and $10,000 on your property tax. On your SALT tax, for a total of $19,000. Okay, so that is a typical situation that a lot of people are going to be in if they have like a $300,000 mortgage. Okay, let's pretend you have a $400,000 mortgage and you're paying, let's say, 3.5%. That would be $14,000. Okay, and then your tax, $10,000 from SALT tax. So that would be a total of $24,000. Assuming you don't give any money to charity, so that's the third thing that usually would be included in Schedule A for somebody. If you just pay your SALT tax and your mortgage interest, and that example I just gave, that would be a total of $24,000. Now, Remember, the standard deduction is $24,400 last year. And so $24,400 is more than $24,000. So you would just take the standard deduction. So all of that interest you paid on your mortgage, all of the tax you paid to your state or for your property, those taxes, none of that matters because you're just taking the standard deduction. You could have been living in a shoebox, not had a mortgage, not been paying any property tax, and you'd still get the same $24,400 tax deduction as the standard deduction in 2019. Okay. So this is the reason why most people are not getting any tax benefits from owning a house anymore. Now, mortgage interest and property tax are on Schedule A. These are the two big things that a lot of people itemize with, and historically, it could save them a lot in tax. Okay? But not anymore. It's something that was added on a long time ago, and it's kind of a stimulus to buy a house. If people are buying houses, then it does move the economy because there's a lot of transactions that go along with home purchasing, home buying, home selling, commissions, obviously, to the realtor, but then it also can increase property value, increase tax revenue, and then you have all the people that are fixing the properties and then furnishings, and there's a big capital economy that revolves around buying and selling houses. So it also is an incentive for people to stay in a place. So, but from a tax perspective, this was something that was incentivized by putting it on the list of things you can take a deduction on. You can't take a deduction on everything like buying a car, or other things, but you can on your mortgage interest. So it is also important to realize that tax deduction on mortgage interest, it's not like you're just getting free tax money back. What it really is you're getting a portion of the interest back that you're paying to the bank. So all it does is it can decrease the effective interest rate of your mortgage. It doesn't really just give you tax back, although technically it does, but what it's doing in practice is just giving you back some of the interest that you already paid. If you don't have a mortgage, there's no mortgage interest. Okay. Now, if you have a $300,000 house, you're probably not itemizing deductions unless you are giving money also to charity to get you over that $24,000 hump. Okay, the average house here sells for around $300,000. Other places is cheaper, other places obviously is more. But typical American, $300,000 house, $10,000 of SALT tax, cap, you're not getting to the standard deduction. And typical family is not donating a lot of money to charity. Okay, but if you are donating to charity, then you can get a deduction on it, but you have to get your total deductions over $24,400 if you're married for it to matter. So last year, we actually did not make a huge donation to our donor advised fund. So we still give regular donations, for example, to some of the charities we support with monthly contributions, which are a lot smaller compared to how much we put into our donor advised fund. Our donor advised fund, which we do through Vanguard, we put in a big chunk in 2018 and a small chunk in 2017 when we got it started. But both of those years were years that we itemized deductions. In 2019, we didn't live in our house. So we weren't taking the mortgage interest deduction or the SALT tax deduction. So our total itemized deductions before charity was like zero. Because when you live in an apartment and pay rent, you can't write off your rent payment and you can't deduct your property tax because you're not paying the property tax. The landlord is paying the property tax. You're just paying rent. So we could have donated a bunch of capital, donated a bunch of appreciated shares to our donor advised fund. We could have put in, let's say, $50,000 into there. But the first $24,400 of it would not have counted because the standard deduction is $24,400. So we would only really be getting an additional deduction on like $25,600. So the tax benefit of that would have been like $7,000 or so. Whereas if we waited until this year, 2020, and we are already going to itemize in 2020 because we are living in our house, and between our mortgage and our property tax, that is already $24,000, then every single dollar that we put into the donor advised fund, all of that will be tax deductible. So if we give last year's contribution and this year's contribution, so let's pretend we put in $50,000 each year, and that's $100,000 in 2020, all $100,000 of that would be effectively deductible because we already hit the standard deduction off of our other deductions that we've already taken. We can't like undo that. So then that $100,000 would save us $37,000 in tax for 2020. Now, remember, if I did half of it last year, it would have saved me $5,000. And if I did $50,000 this year, then that would save just $18,500. Okay, so that'd be like $25,000. Actually, so it'd be $18,000 for this year, $50,000 times 37%, $18,500. And then last year, yeah, we would get like $7,000. So there's basically like half of that we would lose. Okay, so we'd lose like another $8,000 or so of tax deductions, $8,000 back in our pocket that we wouldn't get. So we just waited until 2020. Okay, so we could donate the same amount of money, but get a lot more money back so that we can give a lot more money. Okay, so Schedule A is where people who are definitely, if you're donating a lot of money, you're going to likely be using Schedule A because that's going to help you get over that hump of the $24,400. Now, there's a caveat here. You can't just donate all of your money to charity and take it a tax deduction on all of it in that current year. There are limits to how much you can deduct in a given year off of your Schedule A. Once you hit that limit, then the extra donations and losses would then carry over to the subsequent year. From my understanding and reviewing the tax code, if your total donations are less than 20% of your adjusted gross income, your AGI, then it doesn't matter. You can take 20%. But if it exceeds that, then there are certain limitations, and it depends on what you are donating and where you are donating it to. There are different places have different rules. Like if you donate to a church or certain places, then you can donate up to 50% of your adjusted gross income, potentially. And then it also depends if you're donating cash or if you're donating if you're donating appreciated securities. Okay, so it just depends. Because you can actually donate appreciated stocks directly to a company. We donate them to our donor advised fund. And then from the donor advised fund, we have a gift granted to charities. Okay. But the amount that we can donate in appreciated shares to the donor advised fund, that can be limited to 30% of your adjusted gross income. So if we wanted to donate $100,000 this year into our donor advised fund and be able to deduct all 100,000 of it, that 100,000 would have to be less than 30% of our adjusted gross income. So we'd have to make over $300,000 basically, or almost $300,000 in order to be able to donate 100 and deduct all of that. So that's not an issue for us. So that's how Schedule A works. Once you get to the very bottom of Schedule A, you have the total amount of itemized deductions, and that will kick back to the 1040, and you will deduct that from your adjusted gross income, and you'll get to your taxable income. Okay, let me show that real quick. I'm going to share the other screen, application window, 1040. So there we go. right over here, line 9, standard deduction or itemized deductions. For physician on fire, he had $10,000 of salt tax and $142,000 of charity for $152,000 deduction. They also throw the QBI deduction here, and when you go from your adjusted gross income, you subtract your itemized deductions and the QBI, then you get to your taxable income. Okay, so it goes gross income minus adjustments is your adjusted gross income. Adjusted gross income minus your standard deduction or itemized deduction, and then also minus the QBI deduction equals your taxable income. Then you get to page 2. All right, so if you have enough deductions, you can take your adjusted gross income basically down to 0. But remember that charitable deductions are limited to a percentage of your adjusted gross income. So you need to have enough other deductions from salt tax and mortgage interest in order to get your taxable, your AGI, down to a low enough amount that your tax burden is minimal. Okay, but if you're donating 6 figures in charity, and you have enough mortgage interest, enough salt tax, and if your QBI is big enough, which we'll have to discuss another day, then yeah, your taxable income can get very low, and then you can take all those tax credits, child tax credit, $2,000 per kid, also the child dependent care credit, as well as even the earned income tax credit and the lifetime learning credit, American Opportunity Tax Credit, I believe. So there's all those credits which would then take place after this that can help you get your tax burden further. But itemized deductions, especially if you have a huge mortgage and you donate a lot of money, you can get your taxable income super low, similar to physician on fire. All right. That is our episode number 88. Schedule A. Had to kind of get through that one. A lot of people always ask me about this issue with the mortgage. And so there it is. Schedule A. I'm not going to do that one again. Refer to episode number 88. And we'll get into more interesting stuff the rest of this weekend. All right. None of this is legal, professional legal, accounting, tax, financial, any advice, just entertainment only. For me, for yourselves. All right, have a good one, everybody. Invite your friends to the group. Subscribe to the YouTube channel. Good night.